Hello. Let's take a look at what can be seen in early 2022 and see where they can lead. 2022 will be a year of duality, and not only in numerology but also in economics. On the one hand, the fight against inflation and, on the other hand, the economic recovery after the COVID will be one end of the scale. The causes of inflation are unchanged from last year, including high commodity and energy prices, but it also driven up by a significant divergence between supply and demand. And here we have already arrived at the duality that is expected to define this year. A fight against inflation is needed, which will require higher interest rates and tighter central bank reactions. But at the same time, the engine of the economy must not be stopped. The US Fed did not change interest rates. This is because they have been facing deflationary problems for years, so they are not adjusting interest rates to the current level of inflation, but to a medium-term average. That's why they don't step in until that average is at an appropriate level. Its asset purchase program, which will allow them to inject more money into the economy, is expected to be phased out by March this year due to inflationary pressures. The European Central Bank also pays attention to its inflation on a medium-term average. And until it reaches 2%, it will not raise interest rates. It will stop its asset purchase program that was needed due to COVID, but it will basically rearrange the lines. It will not take any significant steps. As an investor, low interest rates give you a little more leeway, and higher inflation legally results in lower real returns. If you are not getting a negative return, investments that have higher yield than the current inflation have a higher level of risk, and their selection requires caution in the current environment. That's why you need to plan for the longer term and divide your capital between them, so diversify. This duality is not very good news for investment. After all, it makes it less predictable which step will benefit you in the long run. Let's now look at the performance of securities. Let's start with the shares. In equities, the release of the Omicron variant in November was initially alarming. After all, even then, the Delta had just faded away and the news was immediately that the effectiveness of the vaccine against the Omicron was questionable. That is why growth has stalled. But in addition to the high rate of spread, the mutation, which shows milder symptoms compared to previous versions, also fills investors with confidence. This is why a slight rearrangement can be observed. In previous periods, the papers of technology companies soared, which can be traced back to three main reasons. On the one hand, they were able to operate via the internet during the quarantine period. Not only they were able, but they were essential for either the home office, education, or just shopping. Inflation and lending rates were low, so the discount rate was low in a low-yield environment. The long-term cash flow from these companies was thus increased, with the same effect as if they had become more profitable. In other words, the demand for them has increased. The third reason is that people either didn't dare or were not able to consume elsewhere because they ran into some kind of hurdle. That is why capital flowed into these companies, significantly raising their exchange rates. Although it is not ruled out that further good results will be achieved, the three main reasons for support already listed are no longer really valid. After all, offline life has started, so there is no longer such a demand for their services. People can now shop, helping other sectors grow. The yield environment has also changed, which is why their current, already high exchange rates do not allow new investors to make the same gains as those who have opted for them for, say, 1 year ago. The mere fact that you are more likely to find undervalued securities elsewhere also means that capital will flow more there. This is why there is a kind of rotation in the stock market between different stock market sectors. Capital is migrating from one sector to another. Towards the end of November, money flowed from the papers of companies that performed well during the quarantine period, as well as some vaccine manufacturers, to other sectors, so it was during this period that they started to grow. In the picture you can see the 3-month price of the ETF based on technology companies. From here they began to withdraw capital. And where did this money end up? For example, in the consumer goods sector. Here you can think of anything you can buy in the physical world. It's practically anything in the game, from toiletries to products used at social gatherings to cars. As these products had to be delivered, as well as the opportunity to travel, and the price of oil was high, oil companies also performed well. This has a financial background. either on the lending side or just during normal cash flow. That required banks. In a booming economy, the proportion of bad loans is lower, so banks have been able to achieve greater stability and thus greater results. With stocks, you are expected to be able to achieve good results in 2022 as well, but you need to select the sectors according to the market cycle. After the stocks, let's also say a few words about bonds. Previously, bonds were recommended by investment advisors for moderate risk. If you wanted more security than, say, stocks, but you also wanted returns above inflation, a bond could be a good solution for you. While previously government securities followed inflation and corporate bonds brought slightly above, this form of paper now seems to be overturned. This is true both in Hungary and globally. In the picture you can see the yields of 10-year US government securities. It may brighten your eyes that the bond market has finally come to life a bit and yields have risen. Make no mistake, an increase in the yield on bonds means a drop in the price. The declining exchange rate is due, among other things, to the fact that neither government bond nor corporate bond yields are currently keeping pace with inflation, so this needs to be achieved by other devices. And declining demand will also mean a declining exchange rate. In addition, yield curves in developed markets and in Hungary have become flatter. This means that the gap between the yields on shorter-term and longer-term bonds has narrowed. And this is not an incentive to commit to bonds in the long run. The reason for the current situation is that monetary tightening is likely due to high inflation, with investors then looking for shorter-term bonds. Expectations due to uncertainty on the one hand, and the duration of bonds on the other hand play a significant role in this. And another possible variant of the coronavirus makes people risk-averse. Let's say a few words about Hungary. Let's see what is expected this year. The already mentioned duality can also be observed here in Hungary. The global processes affecting Hungary are mostly related to the European Union. In the European Union, with the departure of Angela Merkel, a change of concept has come to the fore, as far as the Union's eastern border is concerned. Previously, the Union was lenient with countries moving away from the democratic line. These are Hungary and Poland. Now this seems to be changing dramatically, and whichever trend comes to the fore, both will end up either returning to democratic norms or losing significant subsidies. Although a new budget cycle has now begun in the Union, Hungary has relied heavily on this resource and is expected to continue to do so. If you take a good look at the picture, you can see that significantly more money is flowing into our country from the Union than we pay as a contribution. In 2020, we received an amount of 4.5% of GDP from the Union. Now, however, precisely because we in the Poles are significantly exposed to European Union transfers, the rule of law mechanism is expected to be launched through the budget. One noticeable sign of this is that payments from the European funds are slipping. Several countries have already received support from the Coronavirus Recovery Fund. The amount of this in the first year is around 0.5% of their GDP, and this payment may be retained to Hungary until the summer. Added to this is the fact that there will be elections this year. The election is mostly characterized by campaign promises. I am thinking, for example, of raising the 13-month pension from 2 weeks to 1 month, or say the law enforcement bonus brought forward from 2023. But it also includes family tax rebates, reductions in contributions such as compensation for raising the minimum wage, or sectoral wage increases that affect certain sectors as a whole. Make no mistake, much of it is a necessary step, but it has a significant impact on the budget balance. The budget deficit was around 3% during COVID. According to the Prime Minister's chief economic policy advisor, these payments and revenue disbursements will raise this level to 16%. Combined with the previous point, this could result in a very difficult economic situation by the end of 2022, regardless of the outcome of the elections. The European Union typically aims to restore the rule of law, or at least does not support autocratic governance. With this, Hungary will receive significant resources either late or not at all. The planned deficit of 16% due to significant expenditures and withdrawal could already be a high risk. Although the government partially covers the budget deficit by issuing government securities, this risk and the global uncertainty can be seen in the increasingly flat yield curve in Hungary. Normally, the yield on government securities issued over the longer term is significantly above that on the short term, and the extra yield achieved in this way compensates investors for the longer term and the higher risk involved. As these two converge, the curve becomes increasingly flatter. This indicates that demand for long-term investment has declined, while demand for short-term investment has increased. The most common reason for this is uncertainty. The source of uncertainty can be a lot. Among other things, investors expect the central bank to take further steps to raise interest rates. Let's look at the steps of the central bank now. The central bank, as the representative of monetary policy, is responsible, among other things, for maintaining the purchasing power of the forint, so for curbing inflation, as well as for supporting the government as a representative of fiscal policy. The impact of this on your life is reflected, among other things, in inflation, interest rates on loans, and real returns on your investments. One of the things the central bank has done in the past year is to fund roughly 1/6 of its public debt, thereby also trying to strike a balance. He solved this mostly by buying government securities. According to the majority of economic experts, the economic recovery has already taken place to an unjustified extent since 2017, which has led to a significant devaluation of the forint. The extent of this exceeded the healthy limits, so the central bank had to step before the forint was put on a path similar to the Turkish lira. That is why an interest rate increase was implemented in several steps, which tipped the forint from its historic low. You can clearly see that by the end of the year the forint had strengthened significantly against both the euro and the dollar. This means to you that all products or services that rely in part or in whole on imports will be less expensive. This will reduce imported inflation. The most obvious examples are oil and gas. With the arrival of spring, the heating season will pass and demand for gas is expected to decline. If the strengthening of the forint continues, these two will also reduce the rate of price increase in Hungary. Interest rate hikes are expected to continue in 2022, as will bank lending rates. In closing, let's look at what to expect on the credit side. The picture shows the level of the central bank base rate. If you compare this with the benchmark interest rate on forint loans, called BUBOR, you can find similarities between the two. I would add, not by accident. What does T.S. mean for you if you want to take out a loan? The only thing is that if you have already decided to accomplish a particular goal on credit, do it as soon as possible. Banks have started to price risks. Here, of course, the risk also means the risk of a rising base rate. Rising base rates will also result in rising borrowing rates, meaning loans dispersed now will almost certainly be cheaper than those dispersed at the end of 2022. In this case, choosing a longer interest period or fixing your interest for the entire term can be a significant interest benefit for you. Let's also look at what a base rate increase means to you if you have existing credit. If you haven't already done so, choose either a longer interest period or a completely fixed interest rate. To do this, contact your lending bank to ask what to do, under what conditions, and at what cost. You will then exchange a loan with a shorter interest period for a longer period. That is, you fix your interest for the time you choose. This may involve startup costs, and it may be more appropriate to think about refinance your loan. You will then exchange the existing loan for another loan that is more favorable for you, either at your bank or at another bank. What you should definitely calculate at this time is how much the fixed interest is expected to benefit you and how much it will cost you. In response to rising interest rates, the government has introduced an interest rate stop. If you have credit and this affects you, your bank may have already sent you a notification. That's why we don't go into it very deeply, only briefly. The interest rate stop applies to loans with an interest period of less than 3 years, and the end of the interest period is between October 27, 2021 and June 30, 2022. Then in the new cycle, banks will have to reckon with the level valid on October 27, 2021 until June 30th. In my view, an interest rate stop is more of a pre-election than a real solution. I think of this from the following. The interest rate stop is valid only for a part of the loans with a short interest period, and thus does not encourage anyone to take steps in line with the current rising interest rate level, in other words, to choose a longer interest period. It is not expected that the central bank will cut interest rates by the end of the half year, so they will be affected by the interest rate increase there and then. Although they have now received nominal help, the pre-existing level is still being paid, so it is likely that the average person will only notice a sudden rise at the end of the summer. Short interest term loans are typically cheaper than longer term loans. Thus, those who would be even more affected are left out of this. Since you can either use this option automatically or not at all, let's move on to what you can still use this year. This is nothing more than a loan called Baby Waiting Loan. It is a significant help to many people to buy or renovate real estate, but even to replace their existing loans. As the amount of this will allow you to start buying an average property, and the banks will accept it in part or in full on your own. So if you are about to buy a property, in 2022 you still have the opportunity to meet the conditions of the baby wait or take advantage of your property. According to the draft, you will not be able to do this from 2023 onwards.